Hello traders, and welcome to another episode of Trade Like Assad. Spotting a legitimate pullback remains one of the toughest and most essential parts of market structure analysis that every trader must master. Developing the ability to detect valid pullbacks empowers you to pinpoint genuine order blocks and inducement areas within the market, keeping you clear of common pitfalls. In today's advanced session, we'll be exploring different types of pullbacks, trading tactics, and the price behaviors linked to these pullbacks that you're likely to see in the charts. But that's not all. We'll also outline the specific guidelines and filters that make a pullback setup qualify as a high probability trade. So, traders, if that's the kind of insight you're looking for, don't forget to hit the like button to show your support, and make sure to subscribe to our channel if you're new. Catch you right after the intro. Welcome back, traders. Let's dive right in. The initial step in mapping market structure is spotting legitimate pullbacks. Without properly identifying a valid pullback, it becomes difficult to anticipate future price behavior, including trend continuations, confirmed structure breaks, or reversal formations. So, what exactly qualifies as a pullback? A pullback, in simple terms, is a short-term reversal or slowdown in price movement that moves against the current dominant trend. It typically forms when buying and selling forces compete for control, leading to a trending or impulsive shift that generates internal liquidity, marked by inefficiencies or static zones awaiting to be tapped or completed. As a result, the price temporarily moves against the prevailing trend, sweeping internal liquidity or resolving static liquidity, before resuming in its primary direction. Price behavior is generally divided into three major components: impulsive, corrective, and continuation phases. For instance, take this corrective phase as a valid pullback. Here, we observe a confirmed structure break. Moreover, we can identify an order block formed near the base, connected to the break of structure, BOSS. In this setup, we expect price to return to the marked order block and bounce upward. To act on this scenario, we could place a buy limit order at the highest level of that order block. Now, suppose the pullback we've recognized turns out to be false, mistakenly labeled as valid due to its impulsive appearance. In such a case, the related order block becomes invalid, and there's a strong likelihood that the price will hit our stop loss. Let's now examine how to correctly identify a valid pullback, along with the essential rules and criteria to follow. Be sure to stay fully engaged with this video until the end, as in the second half we'll break down different pullback patterns, price behaviors, and look into trading strategies tied to the pullbacks you might face in real-world market conditions. Before we get into candlestick examples of confirmed pullbacks, let's take a quick look at candlestick trends, both upward and downward. An uptrend formed by candlesticks is typically seen when the price action prints successive bullish candles, where each new candle closes above the high of the one before it, signaling strong upward drive. In a single bullish impulsive move, it's important that the low of each candle stays the same or higher than the previous candle's low. This shows that bearish pressure is minimal and the trend stays decisively bullish. The same principle applies in reverse for a bearish trend. A candlestick-driven downtrend appears when price action generates back-to-back bearish candles, where each candle breaks the previous one's low, indicating firm downward pressure. During a single bearish impulse, it's key that the high of each candle is at or below the prior candle's high. Now, let's understand how to spot valid pullbacks in a bullish setup. A valid pullback happens when a candle dips below the previous candle's low or sweeps through its liquidity. For instance, in this illustration, the final red candle cuts beneath the lowest point of the third green candle, confirming a valid pullback. It's vital to note that if the price does not dip under the last green candle's low, the pullback cannot be considered valid. Also, the color of the candlestick does not determine whether a pullback is valid. Likewise, in a bearish context, a valid pullback occurs when a candle moves above the prior candle's high, clearing liquidity. This action reinforces downward momentum. Let's continue building our understanding of pullbacks with this foundation in place. Let's review additional examples. Take a sequence of bullish candles as shown. After three strong bullish candles, the price enters a brief consolidation, indicated by the appearance of three bearish candles, before continuing its upward movement. As mentioned earlier in the bullish scenario, for a pullback to be classified as valid, price must dip below the low of the final bullish candle right before this temporary bearish sequence. However, in this case, none of the bearish candles breaches the low of that bullish candle or taps into its liquidity. As a result, this entire candle structure is treated as a single bullish impulsive move, rather than a pullback. Now, looking at a similar setup in the second candle sequence, we observe a few consecutive bullish candles followed by a short pause where only one bearish candle forms. Since this bearish candle fails to break the low of any previous bullish candles, it also doesn't meet the criteria for a valid pullback. On the other hand, if the bearish candle aligns with the previous bullish candle to form an equal high, and the next candle breaks and sweeps below the low of the bearish one, this movement can now be considered a valid pullback. In this case, the structure consists of a bullish impulsive wave, followed by a corrective phase, and then continues into another bullish leg. These principles are equally relevant in bearish trends. It's crucial to understand that these methodologies can be applied on multiple timeframes and on any chart that relies on price action. We're currently examining the EUR-USD pair on the 1-hour chart. As you can observe, the market is clearly trending downward. Let's work on identifying potential pullbacks. By reviewing the chart, we notice a series of 3 bearish candles, followed by a brief consolidation marked by 3 consecutive bullish candles. If we draw reference lines from the high and low of the final bearish candle before the pause, it's evident that none of the following candles managed to exceed the high of that bearish candle. As a result, this movement doesn't meet the criteria for a valid pullback and should be treated as part of a larger impulsive leg. To validate a pullback, price must either break or sweep the liquidity below the most recent candle formed just prior to the consolidation. In the next sequence, we can clearly see that price breached the high of that candle and then resumed its primary downtrend, which confirms a valid pullback in this scenario. Continuing the pattern, we identify yet another valid pullback as price pushes beyond the high of this candle, which marked the last high before the pause. We can also spot an additional valid pullback here, established by this bullish engulfing candle that decisively broke the high of its preceding candle. Now that we've thoroughly covered the fundamentals of identifying pullbacks in part 1 of this video, we're equipped to locate valid pullbacks in real-time market conditions. In part 2, we'll move deeper into advanced pullback theories, covering distinct pullback patterns traders often face and outlining trade setups and strategic approaches connected to pullbacks. Pullbacks generally fall under 3 main categories: aggressive, corrective, and sweeping. Let's now explore each of these pullback types and examine how they can refine and bring structure to your overall trading methodology. Starting with the aggressive pullback, this variation is marked by a swift and steep retracement that moves counter to the dominant trend. It typically presents through a few large, forceful candles that quickly reclaim part of the previous price movement. Let's suppose we're analyzing a sequence of candles like this. Notice how price breaks beneath the lowest point of this candle, the most recent low formed before a pause and reversal. This action qualifies it as a valid pullback. Following the corrective move, price reverses and surges upward with considerable inefficiency. As a result, we now observe a valid break of structure, confirming the legitimacy of the pullback. Given this bullish break of structure, we can now locate a demand zone derived from that movement, which is likely to hold high potential for price reversal upon retest. At this stage, we expect the price to retrace and test our identified demand zone. In the context of aggressive pullbacks, price action tends to return to the demand or supply zone rapidly and with intense force, driven by dominant candles. In such a case, we avoid taking any trade entries, even if confirmation signals like a change of character or flip pattern show up in lower time frames. This is because when price aggressively dives into a key zone without reducing momentum, the likelihood of the zone being respected diminishes. Traders must pay close attention in these setups and refrain from taking trades under such volatile conditions. Now let's move on to the second pullback type, known as the corrective pullback model. But before diving in, here's a vital reminder for your trading journey. Always backtest any trading strategy at least 100 times before applying it in a live account. Backtesting is essential to understand how your strategy performs across various market conditions and to build confidence in execution. The corrective pullback represents a more measured and controlled retracement, generally made up of several smaller candles. During this kind of pullback, price typically forms multiple internal structures as it gradually approaches a point of interest. As the price nears this level, both momentum and volatility begin to diminish, a key characteristic of corrective behavior. As illustrated in this example, We observe a valid pullback since the lowest point of this candle has been breached to the downside. This is followed by a valid break of structure, giving us a confirmed order block, a zone we anticipate has a strong probability of reversing price action upon retest. In contrast to aggressive pullbacks, the corrective model creates internal structures through smaller candles as it slowly gravitates toward our identified demand or supply zone. When the market presents a corrective pullback, we can consider trade entries as the price taps into our zone. There are multiple approaches here, and smart money concepts can be used to guide the entry strategy, whether through aggressive or conservative models. For instance, an aggressive entry may involve placing a buy limit order directly at the high of the order block, anticipating price to activate it. A conservative entry involves waiting for the price to enter the zone, then switching to a lower time frame to detect signs of a change of character, CHO, or a reversal pattern that signals a potential shift in structure. Once a market structure shift is confirmed, you can place your entry at the high of the newly formed lower time frame order block, typically a demand zone formed by the move that caused the character change. The stop loss should be placed just a few pips below the low of the zone, and the take profit can be targeted at the external liquidity zones identified on the higher time frame. Let's now explore the third type of pullback, the sweeping pullback model. In this model, the market creates liquidity pools close to our point of interest by forming structures like equal highs, equal lows, or trendline liquidity. These static liquidity zones attract pending orders and stop losses, making them ideal targets for liquidity sweeps. Recognizing a liquidity sweep before price reaches our demand or supply zone is critical. It strengthens the credibility of the zone and enhances our confidence in the setup. Here's why. Markets need liquidity to fuel strong directional moves. So, if price doesn't sweep liquidity before reaching a key level, it often uses that level to grab liquidity and continue its trend, leaving traders trapped. Take this example. We observe the price retracing down and forming an equal low, which creates significant liquidity just below this double bottom. This indicates the presence of stop losses and pending buy orders, resting right around our identified demand zone. By identifying zones where liquidity sweep patterns appear, we improve our edge. It increases the probability that price will reverse from that zone instead of slicing through it, and helps us filter out false signals or traps. In this case, the liquidity pool located just above our demand zone adds another layer of confluence, signaling a stronger chance for a potential reversal. The next step is to wait patiently for the price to sweep the liquidity below the equal lows. Once the sweep occurs and price taps into our demand zone, we're now ready to consider executing a long position. For optimal entry, we can set a buy limit order at the base of the demand zone. Or, for a more refined entry and better risk to reward, we can drop to a lower time frame and monitor for a change of character, CHO, or any clear market structure shift. Once a new demand zone forms from this shift, we place our entry at the high of that zone, set a tight stop loss just below its low, and aim for external liquidity targets on the higher time frame for take profit. That wraps up our breakdown of the three key pullback types: checkmark aggressive, checkmark corrective, checkmark sweeping. Thanks for watching. We hope this gave you clarity on identifying and trading pullbacks like a pro. Hit that subscribe button and turn on notifications so you never miss new insights. We'd love to hear your thoughts. Drop a comment below and let us know what topics you want us to cover next. Until then, stay sharp and trade smart. See you in the next episode.